Another day, another batch of earnings, and then today we've got 4 names you'll want to watch. Thor, Dollar Tree, HPE, and Crowdstrike just dropped fresh results. Who's outperforming, who's under pressure, and most importantly, who's still worth your attention in a market full of noise? Let's break it down. Thor cruised into Q3 with $2.89 billion in revenue, up 3.3% year-over-year and comfortably beating estimates. EPS landed at $2.53, smashing expectations by over 40%. Solid demand in North America, plus debt reduction and steady margins? That's textbook resilience. But Europe? Not so pretty. Sales slumped over 5%, and margin pressure is building overseas. Rising material costs, especially steel, could make it worse if tariffs kick in. Outlook? They're holding guidance steady. No fireworks, but no panic either. Bottom line? Operationally sound, but internationally shaky. Verdict? Neutral. Dollar Tree just dropped an 11% revenue pop, $4.64 billion in Q1, well above last year. EPS came in at $1.26 adjusted, narrowly beating expectations. Their new multi-price 3.0 model is gaining traction, and the Family Dollar sale puts $1 billion back in their pocket. But the elephant in the room? Tariffs. Management warned Q2 profit could be slashed by up to 50% from import duties on core products. Add to that, increased SG&A expenses and temporary integration costs, and yeah, the ride's bumpy. They did raise full-year guidance. That's a vote of confidence. But short-term, it's rough. Bottom line, smart long-term strategy but serious short-term headwinds. Verdict bearish. HPE quietly delivered a strong quarter. $7.63 billion in revenue, plus 5.9%, and 0.38 non-GAAP EPS, beating expectations. The driver? AI infrastructure demand. GreenLake and NVIDIA-powered servers are picking up serious traction. Now the downside. GAAP earnings took a $1.36 billion hit from goodwill impairment, a one-time non-cash charge, but still ugly on paper. Luckily, they reaffirmed full-year guidance and even declared another dividend. Tariff exposure? Minimal thanks to USMCA production buffers. Bottom line? Not flashy but steady. Strong AI growth and limited macro risk. Verdict? Bullish. Crowdstrike is crushing it. $1.1 billion in Q1 revenue plus 20%, EPS of 0.73 adjusted, well ahead of consensus. Free cash flow hit $279 million, and their ARR surged to $4.44 billion. But there's baggage. The fallout from the 2024 platform outage is still being felt. A revenue drag of $11 million this quarter, and more expected. Still, they've authorized a $1 billion buyback and continue investing aggressively in AI-powered threat detection. Tariff exposure? Close to zero. Their real enemy is macro IT spending cuts, not trade policy. Bottom line? Profitable, scalable, cash-rich, and fighting off reputational bruises. Verdict? Bullish.
Disclaimer: this isn't financial advice, just data, context, and a bit of perspective.
So, 2 bullish, 1 neutral, 1 bearish. Let me know which one you're watching closest, and if Trump's tariffs change your strategy. If you enjoyed this breakdown, like the video, hit subscribe, and I'll catch you in the next TLDR.